Hi, and welcome back to our Mailbag series. I'm Dave Lopez.
And I'm Chase Lopez, and we're financial advisors with ILG Financial. And this is another episode of Retire Your Way with ILG Financial, where we talk all things retirement planning. All right, let's move on to the next one. So this person is 67. So I'm 67. So I've reached full retirement age for Social Security. I don't have plans to retire anytime soon. Should I go ahead and start my Social Security now, or just wait until I'm done working? So I'll start us off on this one, Dave.
Okay.
And it is a similar answer to what we gave to the first one, which is for everyone, it's different, right? Everyone's Social Security amount is different at full retirement age, depending on how much you've made, how much you've paid into the system, things like that. So there's no blanket answer there as far as, when to turn it on, especially if you're still working, right? If you're still working, there's some tax considerations that you want to take in, right? That, again, are kind of unique to each individual person. So I would say, kind of to piggyback off of what we talked about before, is you want to get with your financial professional and see because turning on Social Security is a very big decision for a lot of folks, right? So you want to make sure you have all of the information possible to make that decision prior to making it. And the idea there would be, hey, get with an expert, get with someone who specializes in helping folks that are in retirement or approaching retirement, similar to a firm like ours, to help you kind of walk through all the pros and cons of making that big time decision.
Yeah, and you hit it on your head, because I can't help but wonder, some folks are listening saying, well, I really wanted an answer, which is why I'm listening to the Mailbag.
Yeah.
The answer is it's different for everyone.
Right.
But there are answers. So I'm going to disagree with you on one point that might be different. I can tell you when to turn Social Security on. All I need to know is the date you're going to die.
Right.
And I can calculate the exact rate to time. But since we don't know that, right, then there's a lot of give and take, right? We're making bets on how long we're going to live and when's break even. That's a nice way to say it, right? I turned it on at 67. I get Social Security for 3 years as opposed to waiting till 70. Well, if you died at 70, clearly we'd have been better off taking it at 67. You'd have collected 3 years of Social Security, right? But at 70, the check's much bigger. So how long does it take for this bigger check, this extra money, to make up for that 3 years that you didn't get it? And there's a mathematical answer for that. And then also, if you live considerably longer than that, how big is the difference if you live to 85 or 90? Now, our firm and many others have software that can literally run every possible way you can turn on Social Security. And then we can just put in different dates of death, and it'll tell us when the break even is between two different techniques like 67 and 70. But it'll also tell us if you lived to 95, how much difference it would be, right? One strategy over the other. So that's the kind of data you would need to answer your question. And if you don't have an advisor that has that information, find one who does. Right, we do, but we're not the only ones.
Yeah, and to kind of put a bow on it, specifically if you're working, right, with the Social Security question, there is some tax ramifications, and also, your Medicare premiums. There's some ramifications there. So you just want to be crystal clear as to, all of the different kind of knock-on effects of you turning that on. All right, let's jump into the next one.
Okay.
So my dad is in his 90s and his health is starting to decline. Would it be wise for him to start gifting money to me and my sister while he's still alive, so that we don't have to deal with so much estate tax? And that's estate tax, not state tax. And we've also talked about him signing over his house to us.
Wow, that's a lot. Okay, so I'm going to make it easy in the beginning, because you're the son or the daughter and you're asking this question. It's better for you if Dad gives you $18,000 or $20,000 now. Right? So I'm just joking around in light of it, right? So there's a misnomer, I would say, with this gift tax situation and giving the $18,000, and it's just a misunderstanding. And if when I walk you through this, and Chase and I explain it, if you're like, how could I not know that? It's really very confusing. It's one of these things that when you look at it, you're like, how could they describe a simple concept and make it so difficult? So when they talk about a limit to how much you can give an heir without having to report it, right? It's for 2024, 18,000, I believe.
18,000, called a gift tax exclusion.
Yeah. So
right?
what that means is that if dad wants to give you, in this example, wants to give you and your sister $18,000, he can. You're not taxed on it. He's not taxed on it, right?
Mm-hmm.
And you don't have to report it.
Right.
Now, if he gives you more than that, you're still not taxed on it, and he's still not taxed on it.
Mm-hmm.
The only ramification to giving more than 18,000 is when he files his tax return for that tax year. He's got to include an extra form, which is a gift disclosure,
Mm-hmm.
telling the IRS, I've given more than $18,000 to my son this year. Now, the only reason that's necessary is they will apply that extra
Mm-hmm.
against his lifetime exclusion to estate tax.
Yeah, so let's pause right there. The lifetime exclusion that you're talking about. Basically, the way that the IRS looks at it is they say, hey, you can, your estate, you can inherit a certain number, a certain amount of someone's assets. Once it goes over that threshold, then it starts to incur the estate tax that a lot of people are kind of fearful
and
of.
the deceased pays the estate tax,
Right?
right? So
right.
you as the heir and the what would it be, the executor of their will and their
Right.
estate are going to have to pay it out of their final kind of tax returns.
Right.
But the person inheriting the money doesn't pay the tax.
Right.
But the current, as of the filming of this, the current exclusion
Mm-hmm.
is over $13 million
Mm-hmm.
each. So a married couple, it's over $26 million.
Right.
So
right.
unless you are an individual with over $13 million, you're going to pass on. If your dad, in this example,
right.
has less than $13 million, then he can give you whatever he wants. The downside is filing an extra form.
Right. Right.
Right. So I wouldn't worry about that. And again, we're talking about, and this is a key too, a lot of people misunderstand this, estate tax, which is a separate and additional tax to income tax.
Right.
Income tax may or may not be due at retirement on retirement account, like an IRA or a 401k. Taxes have never been paid.
Right.
Income tax will not be due on a Roth IRA or a Roth 401k. That's another video.
Right. Right.
So complicated topic. Mm-hmm. That's how I would answer the gift question. Mm-hmm. On the second question, Chase, you want to jump in on the question about the house.
Yeah. So the way real estate works, when it gets passed on to an heir, mm-hmm. you get what's called a step up in basis, which is just a fancy term. But basically what that term means is you as the daughter, when you inherit your father's home, when he passes, then the amount that your father paid for the house is largely irrelevant, right? The basis, what they call, or the value of the home when you receive that piece of real estate, is what they're going to calculate if any tax is going to be involved. So I know that was a little wonky way of explaining it, but basically, moral of the story is if you were to inherit your father's home after he passes and turn around and sell it the next day, then there would be no taxes owed. Now, on the other side of the coin, if he were to give you the house today and he were to live 5 more years and then you were to sell it after he passes in 5 years, well, then you would owe what they call capital gains tax on the difference between when he gave it to you and what the value is 5 years from now. So there's no real advantage to having him sign it over to you.
I don't see an advantage either. In fact, it's a disadvantage, to signing it over to you. Mm-hmm. Because you're expecting real estate to only go up. You want to leave it in his name. Now, mm-hmm. if you're worried about probate, and these questions to me seem to be about how do I make the estate probate process mm-hmm. easier. Well, you don't have to give money to make probate easier, and you don't have to title the house over. Your dad can put the house in a trust, that he is the beneficiary of the trust and the trustee, and the trust is written so when he dies, you immediately become the trustee, and the house remains in the trust, so it avoids probate. So you've avoided probate that way. You still get the step up in basis mm-hmm. tax benefit that mm-hmm. Chase discussed on the housing. Mm-hmm. With respect to his other accounts, mm-hmm. you don't have to give the money away to avoid probate on that $18,000. You can actually have on your bank accounts, go to the bank and ask them for a TOD form, transfer on death. or some banks call it a POD, pay on death form.
Yep.
It's just like saying you're the beneficiary of the account. And when he dies, you walk into the bank with the death certificate. If that TOD form's on file, you have access to the account, and it avoids probate.
Yeah. All right. So, Dave, that does it for our mailbag series. Go ahead and hit the like and subscribe button down below to be alerted for all of our future videos, and we'll talk to you soon.
Talk to you soon.